Hi, and welcome to another episode of Money Moves with Debt Rescue, the channel where we help give you information on how you can move your money in a financially empowering way. This week we're going to be talking about interest rates. In the past month, we've seen the Reserve Bank increase the interest rates by 50 basis points or 0.5%, and we thought it's the perfect opportunity to discuss what are interest rates, what are their effects, what causes them to go up and down, and how does that affect us as consumers. So when we're talking interest rates, it all starts with the repo rate or repurchase rate, and that is the rate at which the South African Reserve Bank lends money to the commercial banks. The commercial banks then obviously will add on to that percentages, which will then determine our prime interest rate. And from the prime interest rate, further calculations are done in terms of which money is then lent to us as consumers at the end of the day. So when you listen to interest rates and discussions around, when somebody applied for credit, they could tell you they got it at prime plus 2 or whatever the case may be. That is where the basis of interest rates start and how they get calculated. So what does this mean on our budgets every single month, for example? Why would I care about the interest rate? Well, every time you borrow money and you have a debt to pay, now this is whether it's your home loan, your car, your credit cards, store cards, personal loans, any of those things, the way that the interest affects your monthly repayments is determined by that interest rate. So higher interest rate, you're repaying more. Lower interest rate, you're repaying less. And on your total debt, what this means is if you have to repay an installment every single month, a portion of that money is applied to the interest side of the debt repayment and the rest goes to your capital. So the lower you are paying in interest, the more gets repaid into your capital, which means your balance reduces faster. So when interest rates increase, obviously it means we're going to be paying more. But it's not always the end of the world when interest rates increase, because if you're in the position where you have some money saved away, higher interest rates or interest rates increasing also mean that you're earning more interest, meaning that your money grows a little bit faster as well. So obviously, when we're talking on the downside for us as consumers, where interest rates increasing are not a good thing, it's when we have a situation of we have debt that the repayments we're paying every month, unless you have fixed your interest rates, which most of the times is not applicable, interest rate increases, your monthly repayment amount is going to increase as well. So the question then comes, why do the interest rates fluctuate? Why do they go up? Why do they go down? So during the height of the COVID pandemic, especially at the beginning parts of it, the interest rate was reduced quite dramatically, and it was based on inflation and various factors that were factored in, obviously also factoring in that the South African consumers were struggling a lot. But right now, one of the biggest factors that are driving the interest rate is inflation. The South African Reserve Bank has set what they call their target range of inflation not being higher than 6%. Their guide is between 3 and 6. The moment it starts moving to the higher side, which is the 6%, the way in which they curb inflation and keep inflation under control is by increasing interest rates. And understanding that the idea there is for the inflation to slow down, because fast spreading inflation does have a negative effect. So now that we've briefly mentioned inflation, obviously it takes us back to interest rates. Now, interest rate is a mechanism used to curb inflation, or if obviously inflation drops a lot below the bands, then they might reduce it again. So it's very important to make sure that our inflation stays within those bands that the Reserve Bank has set, to make sure that growth is happening at the projected speeds and making sure that our economy grows in the way that it has to. Now, on a monthly basis, Stats SA will release the CPI or Consumer Price Index, and from that we can then determine what the inflation percentages are and whether we are still within those bands, and if necessary, like we are seeing currently, the Reserve Bank needs to take action, most likely by increasing the interest rates to try and bring inflation back in line. We've now seen a couple of months of the higher percentages when it comes to the inflation rate, hence we've seen the interest rates increases. And we're also expecting, from what the economists are telling us, that this potentially is going to go on for quite some time still, because of various factors currently happening worldwide, which are pushing production costs and the cost of goods dramatically up. For example, if we look towards the Ukraine conflict that's currently happening, it's caused a lot of concern around food security, and that immediately then could affect the supply of goods. goods, which means that demand could potentially exceed the supply of goods, and therefore we could see the cost of goods rise again. So very recently we saw the CEO of Tiger Brands refer to specifically what they are seeing, and this was obviously of very big interest because these are the manufacturers and producers of some of the biggest and most common known brands that we find on our shelves, items such as Jungle Oats and All Golden, Oros and the likes. They can see firsthand what is happening on the ground when it comes to products and the costs associated with them. And one of the first things that they did mention was that they could see that there is an immediate increase already happening in the cost of goods. They've said that it's their policy to import stock in advance to make sure that products such as Albany bread, for example, have managed to keep their prices steady. However, when this stock does run out, we can potentially be looking at price increases in the future. Russia's invasion of Ukraine and intensified COVID lockdowns in China have disrupted supply chain networks and exacerbated cost pressures that were already building up during the pandemic recovery. The ongoing crisis in Ukraine and COVID lockdowns have pushed up the price of hard and soft commodities, things such as oil, wheat, and other grains. And specifically on grains, Tiger Brands have again said they are feeling the pressure on items such as wheat and grain prices, which are very, very high and have increased between 20 and 40% in recent months. And even packaging costs for products such as tin and plastics have increased. Again, these costs are being passed on directly to consumers. Another item that's also been mentioned is the fact that Tiger Brands have said that they're seeing changes in consumer purchasing patterns. Now, this is to be expected because obviously when we go into the shops and we start looking at the shelves, it's natural when we have less rands that need to go a lot more that we're going to start product shopping and looking for the best possible deals that are out there, looking at deals, looking at the lowest cost items and so forth. So it's evident that the suppliers are also seeing this on their side of the aisle. So the one thing we can clearly see is that as inflation rises, inevitably it means that the cost of goods are rising, and what this means for our pockets is we're spending more on basic items right now. So what needs to happen is eventually at some point prices need to stabilize, and the question is when? Well, it's very difficult to say that right now. One of the biggest driving factors is obviously with the Ukrainian conflict that's happening there, because they're a very big supplier of a lot of items that form part of our food baskets, especially when it comes to items like grains and oils and so forth. And until that stabilizes and the fears around food security reduce and go away eventually, we are going to very likely face continued increases and a while until we see stabilization in basic products right now. So the question comes for us as consumers, what does this mean and what do we do? Well, some things are completely beyond our control. We cannot really control inflation and interest rates, but what we can do is be smart. And this goes back again to that thing we keep mentioning, which is budgeting. We need to plan. We need to understand our personal financial circumstances and look for opportunities where we can make changes in our daily expenses. And this could be anything from how we shop, making sure we have our lists, making sure we stay within our budgets, shopping around, being smart about the products that we choose, and also just being conscious of other factors that also contribute here. Because another one that's obviously also on the horizon and is just been continuing to increase has been the fuel price. The fuel price is another driver of items being, their prices increasing. So the reality is we need to be smart, and we're incredibly creative people. Go back to the drawing board, sit in and discuss it with a family and look at creative ways of how we do our shopping, how we put our menus together, and how we can make sure we keep control of our own budget. So that's obviously on the expenses side of life. And when it comes to the debt, understanding that when the interest rate goes up, your installment's going to go up, but where you possibly can, pay in more than the minimum that you need to pay every month. The faster you can reduce that balance, the faster that you get out of that debt at the end of the day, which means you're putting more money back in your pocket in the long run. So every little bit that you can put in potentially now is going to be to your advantage in the long term. If you've done all of that and you're still potentially financially struggling and you need assistance, contact us. Let us see if we can maybe help. Remember that the National Credit Act brought in debt counseling as a remedy and assistance for over-indebted consumers. Let us see if there is potential for us to assist you and how we can help you on your path to a debt-free life. So that's it for this week's episode of Money Moves. Remember to join us next week. We will be talking all things inflation. We will be unpacking inflation, explaining what the drivers are, and also what we can do as consumers to take control of the parts of our life that are affected by inflation. Please remember to hit the like button, click subscribe, and leave comments below so that we can know what topics you'd like us to discuss in the future.